All right, welcome everybody to our webinar today. We will be recording this and it should be posted within 48 hours or so on our website along with the slides. Uh, if you have questions, we will have time for Q&A at the end. I'd encourage you to just put them in the chat and we probably won't take them as we go, but we'll definitely have time at the end. So if you have questions, use the chat. And our topic today is the great sunset of 2026. And just looking at this initial slide makes me think of I have a 2.5-year-old at home. And every morning, we see the sunrise as we're like going down to breakfast. And I've been working on with her. She calls it a sunset, like every morning. And I said, well, no, it's the sunrise in the morning, the sun sets in the evening. And although the sun is setting on TCJA, the sun is going to be rising on a new tax bill here for 2025. So we're going to talk about TCJA, sort of how we got to where we are. And then we're going to talk about what we might think is coming both in, like 2025 and beyond. We have a few other updates that we're going to share. BOI, ERC, some retirement plan stuff. So we have a lot to cover. And today we've got, I always like to say that the firm's two biggest tax nerds are me and Greg. And so we are both tax partners. And there's a lot of people that focus on, new legislation and understanding the tax law, certainly. But I would say the two of us carve out more time than anyone else. So excited to go through this. Greg will start out, sort of take you through some of the TCJA stuff, and then I'll finish up with kind of some of the other issues that we see coming. So Greg, where are we with sort of these individual provisions that were in TCJA?
Yeah, so I want to start out by just explaining where we've been and kind of how we got to where we are today. When we say the great sunset of 2026, what we're referring back to is at the end of 2017, we had major tax legislation. That was the Tax Cuts and Jobs Act, TCJA, and that was basically the Trump tax legislation. It mostly took effect starting in 2018. Some of the provisions have had delayed effective dates. Some things have already begun to expire. But for the most part, the provisions of the Trump tax legislation start to completely phase out in 2026. And so that's what we're referring to when we say the great sunset of 26, all of these expiring provisions. So what are we actually talking about? And you have to think back to what your individual tax return looked like back in 2017, because it's been quite a few years since that tax legislation passed. What we had in the Tax Cuts and Jobs Act, and these are all provisions that were implemented back mostly in 2018, but that will be expiring if Congress and the president don't do something to change what is current law. So we're starting with the modification of the individual tax rates. The tax rates were lowered. The brackets expanded. So basically, we had an across-the-board tax cut for most individuals. What we saw starting in 2018 is far fewer taxpayers were itemizing their deductions. And the reason for that is in part because there was a doubling of the standard deduction. We also had a suspension of personal exemptions. That was at least partially offset with increased tax credits. And then we had a whole slew of changes to itemized deductions. For the most part, it was decreasing the ability to itemize. We had one increase that was an increase in the allowable cash contributions. Formerly, it was limited to 50% of your adjusted gross income. That was bumped up to 60%. But all of the remaining changes tended to reduce your itemized deductions. So the biggest one that we saw was the limitation on the deduction for state and local taxes. So that's state income tax. It's also your local property tax. So what we refer to as the SALT cap, where you're limited to $10,000 a year, regardless of your filing status, a single, married, joint, a $10,000 limit on the SALT deduction. We also saw an elimination of interest deduction on home equity loans. We saw severe limitations on personal casualty losses, elimination of the moving expense deduction, and another significant change for itemized deductions, the elimination of miscellaneous itemized deductions. So that would be for most folks, it would be primarily unreimbursed employee expenses and brokerage fees. All of those were eliminated or severely limited under the Tax Cuts and Jobs Act. We also had formerly we had an itemized deduction phase out that went away with the new legislation. In addition to seeing far fewer itemized deductions, and so far fewer itemizers, we also saw a lot of our clients previously were subject to AMT, the alternative minimum tax. And that also changed starting in 2018. We primarily because we eliminated the miscellaneous itemized deduction and we severely limited the SALT deduction, and we increased the exemption amount for the alternative minimum tax. That combination for alternative minimum tax, you're not allowed to take a SALT deduction at all. You're not allowed to take miscellaneous itemized deductions. So the combination of those three things basically meant far more people were taking the standard deduction, and very few individuals were now subject to this alternative minimum tax. So now looking at some of the business provisions. Starting in 2018, we had a significant drop in the corporate income tax rate. And that was one of the handful of provisions that was in the legislation that was actually a permanent change. And that was the C corporation tax rate dropping from 35% down to the current 21%. Now, to provide some kind of fairness in the tax code, they gave a large deduction for large C corporations. So they came up with a concept of a qualified business income deduction, Section 199A, which basically said if you have business income, we are going to only tax you on 80% of that income. You effectively get a 20% reduction of your taxable income. There's some limitations on that for professional businesses like law and accounting and doctors, but most businesses, this is a significant tax deduction for most of our business clients. That was started with the Tax Cuts and Jobs Act, and again, if there's no legislation by 2026, that provision would go away. We also had the introduction of qualified opportunity zones, a number of benefits with the opportunity zones. You basically invest in certain parts of the country. You had the ability to take a capital gain and defer the taxation on that gain for a period all the way out to 2026 in return for making this investment in an area that they were hoping to provide some economic development. And there were other benefits of that qualified opportunity zone, including an ability to exclude from income the gain that you eventually realize from that investment. This is another provision that if Congress does nothing, the opportunity zone would expire in 26 as well. Few of the changes that we had that were not business friendly. The business deduction for R&D expenses, the research and experimentation expense, or Section 174. This is a provision that was put in the legislation primarily as a placeholder. They were looking for something to offset the cost of all of these business tax provisions. So they put in essentially a placeholder to say, we're going to make you capitalize, essentially add back to income all of your R&D expenses, but we're not going to start that until 2022. And then the hope is, well, by the time we get around to 2022, don't worry, we won't ever let this provision become law. We'll either repeal it or we'll delay the implementation. Don't worry. Unfortunately, if you're a business that has R&D, you found out in 2022 that they did not defer this provision. They did not repeal it. It's on the books, and we have had significant add backs to taxable income for R&D expenses in 22 and in 23. It was something we've seen pending legislation to repeal that provision, but at least as of right now, there is still an R&D add back for 2024. We also saw a 100% bonus depreciation with the Tax Cuts and Jobs Act, but that started to phase out. We're dropping by 20%. We went from a 100% bonus depreciation to 80% and then 60%. Next year we'll be down to a 40% bonus depreciation, and then it completely expires after 2026. And we also had some limitations that were introduced in the tax legislation. One was to limit certain business losses. You could only take a loss of up to at the time $500,000 of a business loss. Any excess you had to carry over to a subsequent year. And then something which has really had a significant impact for a number of our clients, a limitation on the use of net operating losses. Previously, you could use the net operating losses to offset future income in full, but with the Tax Cuts and Jobs Act, if you had an NOL, a net operating loss that was created after the new legislation was effective, those losses can now only offset 80% of your taxable income. So you can never push your income all the way down to zero, no matter how much you have in net operating losses. And then finally, we had the estate tax provisions. What was done here in the Tax Cuts and Jobs Act is they essentially doubled the exemption, and it's increased since 2018 because it's pegged to inflation. So we've seen significant annual increases since then. But if Congress did nothing, the estate tax and the lifetime gift exemption would be cut in half from its current rate. So right now, for a married couple, that's in the neighborhood of about 27 million. That would be cut back to more like 13.5 million starting in 2026. So we saw a lot of clients trying to take advantage of this estate tax provision by making large lifetime gifts prior to the expiration of this provision, and so a lot of estate planning has been done since 2018, trying to take advantage of this temporary increase in the exemption amount. So that's where we've been. What we want to do now is to take a look at where we might be headed with the second Trump administration. So what I've listed here on this slide are some of the more prominent proposals that have been made during the campaign. And I've also listed the cost because, as we'll talk about a little bit later, that's going to become an important criteria for how much they can actually get done. So we start with all of those individual income tax benefits that we talked about on that very first slide. In order to extend all of the expiring individual tax benefits, that would cost about $3.4 trillion. There was also a proposal to eliminate that SALT cap altogether. That would cost approximately $1 trillion. The politics here is kind of interesting because most Republicans do not like the SALT deduction because they see it as providing a subsidy to certain states with high income taxes, namely California and New York. And progressive Democrats also do not like the SALT deduction because they see it as something that's benefiting high income taxpayers. So it's one of these rare provisions where there are opponents of the SALT deduction from both parties, and similarly there are groups of Republicans in California and New York that have been pushing to try to get that SALT limit either raised or eliminated altogether. So it's a little bit different from some of the other provisions that fall completely on party lines. This is one that kind of has some unusual politics behind it. In reversing all of the business and estate tax provisions that would expire in 26, that would cost roughly $900 billion. There was also a proposal to reduce the C corporation, the corporate tax rate. One of the proposals was to drop that rate to 15%, but there's a limit there. It would relate only to domestic production, so it's a more narrowly focused rate cut. That would cost roughly $300 billion. There are also proposals to exempt tip income, to exempt overtime pay, and to exempt Social Security benefits from income tax. All of those provisions combined would cost roughly $2.1 trillion. So now, how do you pay for those? One provision is to repeal the so-called green energy credits. These are the tax credits which passed about a year ago as part of the Inflation Reduction Act. If they repealed all of those tax credits, that would generate about $900 billion in additional revenue. And there have been proposals for increasing import tariffs. The highest tariff, a general tariff on all imports, that would raise about 3.8 trillion. So you add all of those up, and it comes up to a net tax cost of around $3 trillion over 10 years. So keep that in mind. We're talking about a 10-year budget period, cost of $3 trillion. And if you use dynamic scoring, that's where you take into account the projected economic growth from the tax cuts itself. That would still cost about $2.5 trillion. So now that we've talked about taxes, we're going to stop for a moment and have a short civics lesson. So we've got the 119th Congress coming forward in 2025 and 2026. So the results of the election are almost complete. We know that the Senate will be flipping to the Republicans. They will have a majority of 53 to 47. There are two senators that are vacating their seats. Vance will be leaving to become vice president, and Trump's nominee for Secretary of State, Marco Rubio, will also be leaving the Senate. But both of those seats will be immediately replaced by Republican governors in Ohio and in Florida that will appoint a successor until the next election cycle. So that won't have any impact on the balance of power in the Senate. We do have a new Senate Majority Leader. The Mitch McConnell is no longer the Republican leader. He's the outgoing Minority Leader. John Thune will be the new Majority Leader for the Republicans, and it's significant that he is from the more traditional branch of the GOP, and he has already promised to protect the legislative filibuster. We're going to talk about the importance of that, but basically, for legislation to pass in the Senate requires 60 votes. If you only have 53, you can still do certain things, but you need bipartisan support to pass any legislation. So what doesn't fall under the filibuster would be judicial appointments, and what we'll talk about in a few slides, the budgeting process. And again, that'll be important for when we talk about the possible tax legislation and what could be included there. The House of Representatives currently, Republicans have a very narrow majority. Currently, it's 220 to 214. There's still one race not yet called. That is a very narrow margin, and it'll be even more narrow because Trump has nominated and three sitting Congress men and women are resigning their seats. They'll be replaced likely by they're in safe Republican districts. So ultimately, the balance of power there won't change either. But just suffice it to say, there will be a very narrow majority in the House, and the effect of that is that you'll have a situation where perhaps two or three rogue congressmen or women could effectively veto certain legislation. So it makes it a little more difficult if you don't have everybody on board with tax legislation or any other legislation that you're trying to pass in the House. The House has nominated Mike Johnson, the sitting Speaker of the House, to remain in that position. So why do we care about the numbers in the House and the Senate? Well, in order for the Senate to pass tax legislation, they either need 60 votes or they need to use something called the budget reconciliation process. And that budget reconciliation process, they can use it to pass tax bills, spending bills, and debt limit legislation. They're allowed effectively to pass a tax bill with a simple majority in the Senate. They can only have one tax bill a year. So during the next 2-year Congress, you could have a budget reconciliation bill covering tax legislation in 25. You could have another one in 26. And the key here is that part of this budget reconciliation process is that it prohibits an increase in the federal deficit after a 10-year period. That is why we are talking today about a sunset. We had the first tax sunset back in the George W. Bush era when he first passed a tax bill under this reconciliation process. And we had the first phase out. That this was back in 2010 and 11, when we had a one-time elimination of the estate tax, among other things, but it sunsetted. After the 10-year period was up, we had to have congressional action, or these things just went away. Similarly, in 2017, in order to pass the legislation, they had to either pay for everything that they were trying to provide in the way of tax benefits, or else limit the increase to the federal deficit to only a 10-year period. So that's why once we get to 2026, we can no longer have any of these provisions. We need additional congressional action in order to continue these, because of this 10-year rule under the budget reconciliation process. So we've seen what the cost is going to be. We know what the rules are going to be. So now, what is likely to be in tax legislation and what isn't? Well, absolutely everybody is convinced that we will have a continuation of these individual Tax Cuts and Jobs Act provisions. That has been consistent with the planning that the various committees have done. It's consistent with everything that Trump said during the campaign. So that seems like almost a 100% certainty. There could be some provisions that are tweaked a little bit, maybe a little better benefit, or some small limitations. But in general, those provisions should be part of any tax legislation. The SALT deduction, I mentioned, that is one that does not have the same type of support, because most Republicans are actually agreeable to continuing that SALT cap. And again, it's because of which states they see as benefiting from this SALT deduction. So what I would see here is that we will probably see an increase in the SALT cap but I don't think that we're going to see a full repeal. One of the proposals that we saw in the last couple of years was a legislation that would have doubled the assault cap for married joint, for example. Right now, it's a $10,000 cap both for single and for married joint. And so the provision was that we would double that for married joint filers. I could also see some kind of an increase in the cap, and maybe even pegging it to inflation, so that it isn't a fixed 10,000 or some other amount. But I do think that a full repeal is unlikely just because of the politics surrounding it. I do think on the business side that we will absolutely see repeal of the Section 174 R&D expense capitalization rule. That is, again, that's something that has complete bipartisan support. Nobody wanted it in the first place. Again, it was more of a placeholder to temporarily generate some revenue. It has. We've had proposals. It even passed the House under Democratic control, under Republican control. It really wouldn't matter. There's definitely a desire to eliminate this. It's seen as something that's anti-economic growth. So I definitely see this provision going away. The real question here is, are we going to see a repeal starting in 26? Is this something that they will try to make retroactive to 25 or retroactive even to prior years? I think the most likely is that we'll have a repeal effective back to the start of the 25 tax year. I don't think that there's a desire to open up prior years. That they could go back to 24. I certainly don't see them wanting to change 22 and 23. It just creates a lot of additional work, filing amended returns and so forth. And so I think that this is, while it's going to get repealed, I do think it's going to be more of a prospective repeal and not retroactive. I fully expect that we're going to see expanded bonus depreciation. It would not surprise me at all to see it go back up to 100%. Again, I think the issue here is going to be when is this going to be implemented? We've had a change in bonus rules many times in the past, and at least in prior tax legislation, they have done a mid-year change in the rules, basically saying if you placed property in service prior to the effective date or the markup date for the legislation or some date that they set, you're under the old rules prior to that date, and you're under the new rules starting with the date that they select mid-year. So I, at least based on what we've seen in the past, I think that's the most likely, but then again, they could always do something a little bit different. But I do expect that we're going to see expanded bonus depreciation. On the estate and gift tax, I genuinely think it is not going to change at all. I don't see them making changes to increase it. I don't see them repealing the estate tax. And I certainly don't see them cutting the exemption in half. I think the most likely change here is to simply keep the status quo, the 27 million or so for a married couple. And then the question would be, would they make that a permanent change, or would it once again be some kind of a 10-year window or some other window like we had with the 2017 legislation? I also see likely continuation of qualified opportunity zones. This is one of these provisions that does have bipartisan support, so I can't imagine it not being continued. again, the question is going to be, will it continue as a permanent provision? Is it going to be one of these sunsetting provisions? And will they tweak the program at all? Also, if you took advantage of the original qualified opportunity zone in 2017, you've got a tax bill coming due in 2026. So question then will be, are they going to do something to allow continued deferral of that original gain deferral if you took advantage of the first program? So that's one where it's kind of hard to predict, but in general, I see a continuation of the program. I mentioned one of the proposals that Trump had was to, with the a corporate tax rate, dropping it to 15%, but only applying that rate to domestic production. And that to me sounds very much like an old provision that was actually repealed by the Tax Cuts and Jobs Act. That was the old DPAD deduction, the domestic production activities deduction, which basically gave you an exclusion of income, an additional deduction if you could show that you had domestic production activity. So rather than a second corporate tax rate, I think if they implement something like that, it'll be a return to something similar to what we had with back in 2017 with the DPAD deduction. There's always a possibility of reduction in overall rates and capital gains rates. It isn't something that was discussed. It was never a significant proposal during the campaign. So I don't know if it's going to be an extremely high priority, but maybe the top rate, the current 20%, could be scaled back, or maybe they increase the amount that's subject to the lower bracket amount. It's always something that's talked about, so it's always a possibility. But again, just based on what was talked about during the campaign, it's maybe not the top priority. And then with the green energy credits, I can see them scaling them back. I don't know that we're going to see a complete repeal, just because a lot of businesses, a lot of individuals are counting on those, and so they're supposed to go out for about another 10 years. So I could see maybe some of those outlying years being scaled back, but I don't know that they would just completely repeal them for 25, 26. And I certainly don't see anything that they would do that would be retroactive. So if you have a project in place right now, if you're doing major home improvements, solar panels or something of that nature, I certainly would move forward with that. I can't see them doing something retroactive to take that those credits away. So what are some of the things that we are not likely to see in 2025? Well, one of the proposals was to exempt tip income from income tax, also to exempt overtime pay from income tax, and all Social Security benefits from income tax. And personally, I think this was more of a campaign item than a serious policy proposal. Social Security could certainly the taxation could be tweaked in some way so that you're paying on less, or perhaps a complete exemption. So that one's a little more of a possibility. The tip and overtime provisions would be extremely complicated to implement. It's not considered to be especially good tax policy. It's not really clear what you're trying to accomplish with with either of those. So I think those are least likely to be included in a final tax bill. We also every so often this idea of indexing capital gains comes out, and every time that it's proposed, it fairly quickly gets shot down again because of just the complexity of trying to deal with it. This is effectively a provision that would only tax capital gains that are not due to inflation. So you would, for every time that you sold capital gain property, you would have to look to when you acquired it and what the inflationary component of your gain was. In effect, it would create like an infinite number of capital gains rates to apply, and you could, in theory, have multiple rates applying to a sale if you acquired securities, for example, on different dates. So it's one of these provisions that sounds theoretically very good and makes a lot of sense, but just the practical effect of trying to implement it, I think, makes it highly unlikely to be included. One of the ways to pay for the legislation is various tariffs. Now, the one that would raise the most revenue is a general tariff that would simply apply to all imports. And I think that that's extremely unlikely, if for no other reason than the last time that we had tariffs in the first Trump administration, it resulted in almost immediate retaliatory tariffs on our exports, and that had a dramatic effect on farmers, especially folks in the Midwest. And so I think there's going to be a very limited appetite in Congress for any kind of massive tariffs. What I suspect is, and based on everything that I've seen and read since the election, is that tariffs and the threat of tariffs are going to be used in a much more targeted fashion. And I think in a lot of cases, we're going to see them as not as a revenue raiser, but rather as something that would be used to try to gain either trade concessions or some other concessions. In fact, just over the weekend, we saw a threat of an import tariff if countries did not continue to use the U.S. dollar as their currency. So things like that, and there have already been proposed tariffs on Mexican and Canadian imports. But the desire there was to get Mexico and Canada to bolster their border security to either reduce drugs crossing the border or undocumented aliens crossing the border. So again, even before taking office, we're seeing these tariffs being used primarily as a way to gain leverage, as opposed to trying to raise significant revenue. Although I do think there are going to be some, and as I said, I think there'll be much more of a targeted nature. So we will see some revenue being generated, but I don't think it's going to be at the level that some of the most the largest ones that would raise $3 or $4 trillion. I just don't see that happening. What I do see happening is very likely another 10-year sunset or some kind of a sunset of the tax benefits in any kind of a proposal. And the reason there have been some proposals to tweak this budget reconciliation process. One proposal would be to use the current tax law as a baseline and not count any of the expiring provisions as adding to the deficit. And while I think that's, they can basically do anything that they want, I do think that there are enough Republicans in both the House and the Senate that would fall under the category of a deficit hawk, somebody that is concerned about these outlying federal deficits. So I think we will see some kind of a limitation. We're going to have large tax benefits in the bill, but I just don't see them wanting to completely cast aside the whole idea of no concern at all about the federal debt or the federal deficit. So I think there's going to be more of a muted tone as far as how much they can pack into one tax bill. So, looking at how does all of this impact what we might be doing today and into 2025? I do think that we're going to see corporate and individual tax rates that are either lower in the future or at the very least, they're not going to increase for the next 4 to 5 years. And I say 4 to 5 years because that would be the 4 years of the Trump administration, and it generally takes about a year before you can have any kind of tax legislation that would increase rates. And I don't see the Trump administration doing anything that's going to raise individual or corporate rates over the next 4 years. So what does that mean? Well, for those that were concerned about increasing tax rates in the future, I just don't see that happening in the near term. So there's no need to be accelerating income into earlier years. That if anything, you should be finding ways to defer income, hopefully into at least 2026 if you can. Things like installment sale gains, better to push those gains and other income that where you have some control, push that out into 25, 26 or later. As far as those green energy credits, they're on the books now, lasting until 2032. I can absolutely see those getting scaled back, but again, I can't imagine them just pulling the rug out on people that have already have projects in place and businesses that have set up around these credits. So I think there's going to be more of a phase out rather than just an abrupt repeal of these credits. I do think that the bonus depreciation will be enhanced, and that could happen as early as 2025. So again, if you're relying on the bonus depreciation provision to take deductions, if you are looking at equipment purchases, it may make sense if they're not time sensitive to push some of those off into 2025. Many of our clients are using the Section 179 expensing elections, so that likely is not going to be impacted at all. You can continue to expense under that provision. But if you are relying on the bonus depreciation provisions, I suspect that in 25 we're going to get a better result than we are in 24. And if it does change in the middle of 2025, then you're better off in the latter part of the year than the first part of the year. First part of the year, you're going to be limited to 40% bonus depreciation if they don't make a change. We talked a little bit about the qualified opportunity zone. Again, I see that as being continued. If you are considering a qualified opportunity zone, and if you do have the luxury of time, a lot of times you can wait a year or more from when you recognized a gain to make your investment. So if you have the ability to wait and see, it might make sense to see what's being proposed. A future program might have benefits that are better than what we currently have with the existing law. And then lastly, I mentioned that how many clients that we had that were focused on the possible change in the estate tax, the exemption dropping from around 27 million to 13.5 million or so for a married couple, or individuals where the rate again was going to be cut in half from roughly 13 down to 6.5 or so. And in a lot of cases, we tried to discourage this, but we had clients that were putting themselves into long-term positions in terms of their estate planning based on what might happen in a few years, rather than looking a little more long-term. And now that we've gone through one more election cycle, it seems highly unlikely that we're going to see a drop in the estate tax exemption. But the problem is that a lot of these estate plans are locked in place, difficult to change, and in a lot of cases, people are going to be stuck with these planning techniques that aren't necessarily the ideal for the long term, but they're kind of stuck with them in some cases for life. So I think the moral of the story here is with income tax planning, estate planning, look a little bit more to the long term and not necessarily react to every proposal or possible tax law change, and take more of a wait and see approach to see, nobody can really predict what's going to happen, and so trying to plan around a piece of legislation that's going to expire in a couple of years is maybe not the best way to do our planning.
Greg's probably the best estate guy I've ever run across, so you should definitely listen to Greg as it relates to estate tax things. But some other thoughts along the way here. PTE, pass-through entity taxes, have become a big thing in the past couple of years. They came about because of the SALT cap. So if the SALT cap changes, a lot of the motivations and the planning for those PTE scenarios could change as well. The whole point of PTE was, well, if I can't deduct my state taxes, then I should do PTE instead. That's the basic. But now if I can deduct my SALT, if I can deduct my taxes or more of them, the math changes on that. So I think we'll see some changes there. Inherited IRAs have been a problem where the IRS guidance was just lacking. They finally have final regulations. So we have some clarity on those things. That really starts to apply in 2025, 24, and before they kept exempting because the rules weren't clear. So I think that's good news for people with inherited IRAs. There's, looking down the road, even a year or so, I think there's a couple of things that can happen here. Greg talked about some of the big tax proposals, like what happens to the salt cap. Well, related to that or in that same kind of a bill, potentially, you could see other things like a reduction in funding for the IRS. The key part there is like which bucket of money does it come out of? Because the IRS has very strict like buckets of money for what they can spend it on, and they got a bunch allocated. They've already sort of reduced some of that. So I think you could see further reduction in that funding. Um, and I think there's a pretty decent chance that we see, and I would call it like a tax administration bill, which could even be as early as sort of this lame duck. So that tax administration, we're not talking about the corporate tax rate. We're not talking about itemized deductions. We're talking about a lot of things related to disaster relief and just good tax administration policy, things that are not partisan. They're not really designed to raise or lower revenue. Is just to smooth out the process of a lot of these things. And it is very bipartisan. And I know there are some proposals that have some pretty good support on both sides. So I think something like that could come about. Um, and I think that would be a win for taxpayers, for tax preparers. That would be excellent to just get some more clarity around those things and nail down what is, I think objectively everyone agrees good tax policy, even though it has nothing to do with sort of who's paying how much tax. Um, I was in DC, I guess it's 3 weeks ago now, at the National Tax Conference. There were people from the IRS there. There were meetings afterwards. So I think we can expect to see an uptick of audits of flow through entities. The IRS has got units on these. They're finally getting trained. They're coming around to the fact that it's some of these big flow through entities where they need to have better sort of audit procedures because that's where a lot of the money goes. It's affecting a lot of things. Um, Audits of partnerships in particular, and the new BBA rules make that incredibly messy if there is an adjustment. But I think we'll see an uptick in those types of audits looking at specific things and just, I would say, general audits. Um, the IRS has made a bunch of improvements as it relates to online individual accounts. They have a bunch more improvements that are coming. The IRS is very proud of this. I mean, I think the technology at the IRS is a little behind the times. They're proud of the kind of thing that, you could do at your bank 15 years ago. You're maybe just being able to do it now at the IRS, but better late than never. It is a legitimate improvement. And I think there is a compelling reason now for essentially every individual taxpayer to sign up for an online account with the IRS. It is, I think, clearly the preferred way to make estimated tax payments. It is going to help you administer your taxes more smoothly. It can potentially help us help you resolve tax issues, whether it's notices, just little notices, or figuring out the estimates or getting transcripts, that kind of stuff, getting power of attorney set up is going to be done through these online accounts at the IRS, but it only works if the individual person has the account. Certainly down the road, they might get more business accounts, but at the moment, it's really focused on individuals. I personally have one of these accounts set up. It might take 15 minutes to get it set up, but I think there is now a compelling reason for essentially every taxpayer to have one of these. Partially related to the IRS processing of amended returns, which has been a disaster lately. the BBA rules for partnerships, which makes amending just not possible, the tax law that might pass this summer. I really think we're going to see a huge uptick, and the incentive has dramatically changed to extend business returns. But that does not necessarily mean filing in the summer. I know in the past, sometimes we're like, oh, they might fix 174. Let's extend and just sit on these returns. I will file them later. I think the pendulum is swung there. Superseding of returns is very similar to amending, but it's become much easier to do. They can be e-filed. The amending of returns is just become a worse and worse disaster with the IRS. So filing an extension, even if you choose to file the business return on time, is something that we're definitely going to push people towards. They just announced recently the 1099K reporting threshold, which has, been going up and down and up and down and getting extended and extended. It's going to be $5,000 for 2024, likely to be 2,500 in 2025. That's another kind of thing that could get sort of permanently adjusted if a tax bill passes. So that limit has just been jerked around so many times in the last, 3, 4 years. But that's where it is now. So I have a few other updates. They really aren't going to relate to TCJA, but they're important things, and I think we'll get through them pretty quick. If you do have other questions, definitely use the Q&A, and we will get to it, whether it's about some of the tax stuff from before or these upcoming topics. So on the ERC, which is, I feel like, where I've spent the vast majority of my time for the last 3.5 years now, almost 4 years. We got a lot of notices coming out from the IRS. None of them have been correct. Not a single one has been accurate, but we're seeing lots and lots of notices. So we're responding to those and we're appealing them. And, I think we can provide all the documentation they need to eventually get them resolved. But for people that are getting a notice, it's definitely bad news because the processing time on those would appear to be infinite. The first sort of batch of these we got, and we responded in August. They have not read a single one of those. And when I was at the tax conference with a bunch of other people that do a ton of ERC, they were all saying the same thing. We've appealed these denials or these letters. None of them have actually been heard. So I don't know how long it's going to take. But with a lot of things with ERC, it's just going to take however long it takes at the IRS, but bet on a very long time. The second voluntary disclosure program they had was now closed. I fully expect there is no chance there will be a third one. The withdrawal program, however, is still open. There's no expiration date. I kind of think it'll go away April 2025. But the guy at the IRS who's in charge of ERC enforcement, in a small meeting said the withdrawal program was his favorite thing. He said it was the best thing they were doing right now. So I definitely expect it to stick around. I do think a bit of good news is coming. The IRS is supposed to have an announcement regarding the statute of limitations problems. Statute of limitations problems are super icky and a big, big mess because the income tax and payroll tax statute of limitations are not the same. Combine it with the very slow processing of the ERC claims, and you really get a mess. That is a top priority for the IRS. I don't know what the announcement's going to say, but they intend to address those situations. I am optimistic we'll get it before the end of the year, calendar year. Lately, just so you know, like we've seen the claims from filed in the summer of 2023 and even some in the fall of 2023 getting paid out with checks. So that's where they are with processing. That's 12 or 15 months to get processed, but that's kind of where they are. But I've seen some notices even on a claim filed as late as December 2023. So they have those claims and they're clearly starting to look at them. So we're getting movement after, we went months and months with no movement at all on any of the ERC claims. I think the gears are definitely starting to move there. Lots of enforcement yet to come. And, a piece of a bill that could pass next year would extend the statute of limitations for ERC and potentially raise some revenue. So when Greg's talking about all these provisions they want to do, one way they could pay for some of that is by sort of increasing the penalties on the bad ERC promoters, extending the statute of limitations so they can sort of claw back more of the bad ERC money that raises revenue, which they can spend on some of these other things. So, and that passed the House, like 11 months ago. It just didn't quite get through the Senate, even though that piece had bipartisan support. So I think that piece is likely. Not sure exactly what it'll look like, but something along there because they realize there's a ton of fraud and they want to get after it and it raises revenue and both sides agree. So it'll find its way into a bill, I would think. BOI is very important. We're almost to the end of the year now. The end of the calendar year is when these reports are due. We've helped something like 250 clients so far. We got a bunch more sort of in the queue, but a bunch of clients have filed it themselves. And I think self-filing is a viable solution in some situations. So if you kind of know what you're doing, it can be pretty quick. It is a relatively simple filing sometimes. Sometimes it's very complicated and you don't want to make mistakes, so we can definitely help you. We got a BOI team, contact information on the page. There is a resource. I made a separate video going through sort of what all the rules are in detail, how you would go about filing it yourself, how you can use us if you need help with that. So we're available to help if you need it. The most important thing is that you get it filed if it's required. That's the most important thing. Whether you do it yourself or we help you with it, either way is fine. But basically, every entity set up in the US has got to consider, every LLC needs to consider, do they need to file a BOI report? Every Inc. needs to consider, do I need to file a BOI report? Even single member LLCs that, just have a little consulting income in them or have a rental property in them, they need to be doing BOI, or at least considering if they need to do BOI, because the penalties for failing to file are crazy. It's very unlikely, I think, that it gets repealed, but I do think there is a small chance, personally, I think it's very small, that a 1 year delay could sort of make it through during the lame duck session. Seems unlikely to me, but there are definitely a few people out there pushing for a 1 year delay. I wouldn't bank on that. I'd have them done by year end. So a couple other things here on retirement plans. We're not going to go through this in great detail. Just want to be sure you're aware of some of these because these are coming around, either 24 or 25. Secure Act 2.0 is a few years old now, but some of the stuff really is still taking effect now. Like auto enrollment is going to be required in 2025. It's required for new plans. So automatically enrolling employees is just a provision now. That's what they're pushing towards. They want more people using plans for retirement. That's what it all amounts to. There's increased catch-up contributions. There are tax credits for retirement plans, both for setting them up, like the administrative cost of setting them up, and also for some employer contributions. There's rules and rules and rules around how much the credit is, who qualifies, what's big, what's small, etc. I think I'm working on a resource still for that, but just being aware that they're available. Qualified student loan payments can come out of retirement plans. That can be an option in a retirement plan now. It expanded some of the coverage for part-time workers and also allows for Roth matching contributions to be elected by employees. I think even like either this week or next week, internally, we have a session about how to do that in our own 401k plan. It wasn't an option before, now it is. So we're going to go through and sort of explain to people what their options are. For the Minnesota taxpayers in particular, this feels a lot like some of the stuff in Secure Act. They want people to contribute to retirement plans. So Minnesota passed the Secure Choice Retirement Program, SCRP for short, I guess. That doesn't exactly roll off the tongue, but phase one begins, 28 days from now. It doesn't mean quite as much as it sounds like. It sounds like, oh my God, January 1st, the whole thing changes. That's not really what it means, but the rollout begins in January. Big picture, what is the deal with this? They're getting at employers with 5 or more employees are going to be required to participate. The employees are going to contribute a portion of their pay into essentially an IRA. It's this public-private partnership where Minnesota is essentially going to require the employer, but then offer to sort of administer the IRA for the employees. Very, very light on details. Like, that's about all the details there are. More things are going to come out in 2025, but you read the law and it says, well, you got to start phase one January 2025. And then you read the detail and they're like, we appointed the board of the people who make the decisions, but they haven't actually decided any. They haven't announced these things. But the assumption is there's going to be an IRA for every employee. They're going to be required to participate unless they elect out or something. And then the state is going to manage these IRAs. They're going to manage the funds inside the IRAs, similar to how they manage like pension plans, state pension plans. But the employer is going to have a choice. You either offer a retirement plan to your employees, or you are going to be forced to use the state-sponsored plan. You're not going to be forced to do it, I don't think, in 25 here, but possibly in 26 because they really don't have this thing off the ground yet. But that's the idea. You'll have to offer it to employees. The employer does not have to contribute money to it, but they have to offer it to employees. So I think it's going to end up being, it's free in the sense that the business does not have to make a contribution. But it has the potential to be, I would think, kind of a nightmare if you're forcing all your employees to use a state-sponsored IRA. When the employees are confused by it or have questions about it, they're going to look at the employer and be like, what did you get me into? So I think the employers have this choice of like, all right, do I want to get them in a plan that makes sense, that's simple, that they can administer and they have, available to the employees? Or am I going to get sort of roped into using this state-sponsored plan, which I don't know if it's going to be administered very well. The rollout of this seems awfully slow to me, based on when they pass the legislation and they're, I have concerns about how well this is going to be rolled out. My wife had a state-sponsored pension plan for a while, and we got out of that because it was not super friendly the way it was administered. So forcing all your employees to use it, I don't know that that's gonna garner a lot of goodwill with your employees. So I think that's when you're looking at, all right, So should I do something else proactively on my own if I have more than 5 employees and I'm in Minnesota? And that's where I'd certainly be looking at it. And you can sort of combine that with, oh, well, can I get a little tax credit for setting it up too? Can I get a tax credit for doing the employer contributions? So I think that's why I sort of put these two together because they certainly go hand in hand. A few key numbers. I'm not going to go through these. We'll just leave them in the slides if you want to go back and look at them. But with that, I think we'll take any questions if you have them in the chat. Otherwise, as we've talked about, there is a good chance. I mean, Greg, what kind of odds would you say that a tax bill passes in the calendar year 2025?
I would say probably 100%.
Yeah, I mean, I would
And
say 99
I,
probably, but
I would even go so far as to say it's probably going to be in the early part of 2025. They appear to they've been working on this since the beginning of last year. So this the last time it took them until December of the first year of the Trump first administration to get a tax bill. This time I really think they could get it as early as like late spring or early summer.
yeah, I think if I was betting on a bill passing, I bet on second quarter 2025. Um, and personally, like if I had a second best, I'd probably say third quarter and then first quarter. But yeah, like this thing is gonna be moving. I don't know if it can move fast enough to sort of get through first quarter 2025, but I think second quarter 2025 is the most likely time we're gonna see the bill actually come to fruition. And so certainly we will be back if and when a tax bill passes. Look forward to it. Can't wait. So I think with that, we'll sign off. If you have other questions, certainly reach out to us. We'd love to talk to you more. Greg would love to break down every congressional race that is the one that's still uncalled. I'm sure he has thoughts on that. But for now, I think that's it, and we'll post this recording on the website, within the next 48 hours. So thanks, everybody.